Hello and welcome to this edition of All About Your Company. I'm Harsh Saita. Very quickly, today we're going to be talking about Ugro Capital, not something that investors have made too much money on, but at the same time, it's interesting for multiple factors. You look at the kind of stock decline we've seen a 38% decline over the last 6 months, but frankly, we've not seen a deterioration in asset quality, at least here. And that's why we'll try to delve into what's playing out. So one is the 6-month chart, that's 38% lower. Look at the 12-month chart as well. And we've seen some serious downtick on the stock price, which traditionally used to hover around 200 plus. It's down 43% in the last 12 months. Can we pull out the 2-year, maybe the 5-year chart at all if we can? That'll give a much better perspective on what's playing out. But really, what seriously happened is there's been a huge wealth erosion. Of course, it's come out with its Q4 numbers as well, and we'll try and analyze that print. Let's look at the stock intraday. Is it really moving or not? Intraday is what I'd also want to quickly understand. But that 2% plus ROA print didn't look bad at all, at least from, so doing nothing much, 0.5% lower intraday as well. That 2% plus ROA print, not really pushing up the stock price today either. And one of the reasons for that is there's been a big shift in strategy. And this has happened on the 7th of February 2026. What's happened is they are likely to wind down 67% of their loan book. Their loan portfolio of nearly 10,000 crore of the 15,000 crore is going to be wound down. We'll try and understand the rationale for that, what is likely to play out going forward. They're now going to focus more on emerging market loan against property to MSMEs and embedded finance, which is nothing but loans through PhonePe, BharatPe, Google Pay, as well as Paytm and the like, even though currently their tie-ups are with PhonePe and BharatPe. Really, that's what their focus area is going to be. And therefore, what you'll see is a rundown of 10,000 crore in terms of loan book, which is a lower yielding loan book, and a tilt towards a higher yielding loan book in terms of emerging market LAP and as well as embedded finance. Really, those are the two verticals. Now, let me talk a little bit about the other pieces which have been moving. One is they've acquired a company called Perfectus at one-time book. This happened obviously a few quarters ago. And currently, the stock also trades at sub one-time book. And well sub one-time book, probably 0.6, 0.7 is what this one trades at. So after this very sharp correction, is this an interesting story, and how does the story unfold? We'll try and delve into that. The first one, let's try and understand what the company does. It's a registered NBFC lender. It's data tech driven in terms of its lending process, and it lends primarily to the MSME space. It's professionally managed. There's no single promoter for the company, even though Sachindra Nath, who manages it, owns approximately 2%. And we will, in fact, speak with him as well. He's managing director of the company. And the market cap sits at around 1,800 crore at this point. When you're looking at products, one, it's in the secured business loan segment. These are term loans within the housing space. They also do secured business loans to MSMEs with housing or property as the key collateral. So that's the big tilt which they have in terms of the portfolio, and they're going to continue to do that going forward as well. Then there's embedded merchant loans, which is digitally sourced loans through merchants. So you'll have around 300 odd branches which they currently have, which will distribute loans, which is secured business loans. And then there's embedded finance, which is the unsecured piece, which yields 26%. And that will be the balance of the book. So we'll try and get a structure as to how this will evolve. But let me talk about some of the other segments that they currently have their loan book tilted towards. Around 15,000 crore loan book, out of which these two are just 33%, which is 5,000 crore. The balance is all of this that you can see on your screen: equipment loans, supply chain financing, co-branded loans, school financing, and co-lending also. So they earn a fee on the co-lending that they do, which is an upfront fee. All of that will likely start to go away, and the largest focus will be on those two. Let me talk about geographies in terms of the tilt of the loan book. We'll come to this in just a minute. And this is, of course, the product mix currently, which is 33% emerging market, embedded finance, all the others is around 67%. This is their presence, and 27% presence in Maharashtra. In terms, this is loan book presence, right? So this is not branches presence, this is loan book presence. 27% is Maharashtra loan book tilt. And then you have Tamil Nadu and Karnataka, which is roughly 25%. 10% Gujarat, Rajasthan, UP, MP is another 18%. And then there's others, which is approximately 10%, which constitutes your full loan book. So there's a good tilt. 3 states with 50% plus, and then you have another 3 states with 30% plus. So 6 to 7 states, 7 states precisely, have over 70% of the loan book, and then total presence is 13 states. That's broad brush in terms of the presence. They currently have around 3.2 lakh customers. The aspiration is that by FY29, they will have 4.5 lakh customers. So the customer count will also likely go up. Now, in terms of their acquisition, they've acquired Profectus in an all-cash deal. They issued equity for that, and they got in an AUM of around 3,500 crore, which added to their AUM. Their current AUM stands at around 15,000 crore, so it was a substantial acquisition for them. And Profectus basically brings in the secured part of the business, and along with the school financing and the like, but the secured part of the business, which is what they are looking to grow in, which kind of gives you a tilt of how and what is playing out. Now, let me talk about the financial metrics, and I'll start by talking about the net interest income. It's grown at a very healthy clip over the last 3 years. It's grown at a clip of around 30% in the last 3 years. That's the compounded annual growth rate. Pre-provisioning operating profit has grown at an even faster clip of around 48%. So you've seen very, very sharp increase in operating profit as a result of a very, very low base as well. 140 crore, virtually double in FY24 itself. Net profit has gone up 64%, again off of extremely low base. And if you see the provisioning number, it's been fairly controlled. Let's pull up the provisions. That's the provisioning number, in fact. And what you're seeing is it's fairly controlled. And thereafter, let's pull out the profit after tax number. And that'll come up on your screen in just a minute. There you go. So that's the PAT. Again, provisioning coverage to PAT has been low. And that is one of the other concerns which the street could have. So that's one. Second, when you're looking at provisioning coverage ratio, and I'll come to that when we look at the operating metrics, that could be the other concern. Let me talk about AUM growth now. And when you look at the AUM growth, it's been at 31% YOY. No concerns here at all, because your net interest income has also grown by a commensurate number. And of course, a large part of that FY26 AUM growth that you're seeing is the acquisition as well that they've done. So broadly, that's how it's played out. Look at capital adequacy now. Capital adequacy has fallen sharply. It's risen a little bit in this year because profitability has come through, but growth hasn't, because you've got that entire acquisition which has come through, but there's been no growth on the book itself. And therefore, what you're seeing is your capital adequacy has inched upwards as a result of that. You've seen a lift in capital adequacy. Also, capital adequacy is expected to remain reasonably healthy till FY29. No fundraise is also what they have guided for. Now, let me talk about the operational metrics. And this is where it starts to get interesting, because these metrics will well change. You look at the yield on advances, it's been fairly steady between 16.5% and 17.5%. Your margins, these are margins reported by or calculated by Elara, and we've relied on that number because Ugro doesn't disclose their margins. So broadly, it's between 6.5 odd percent. That's the margin that they currently work with. The cost to income ratio is approximately 54% currently. It used to be 62, so you've seen a tapering down of that, which has aided profitability. That kind of explains the kind of profit increase. The cost of funds sits at around 10%, 10 to 11% odd. So that is certainly elevated. Of course, a better rating would probably give them scope to reduce their cost of funds, which could also further spur profitability. You look at your ROA ratios, they're currently at roughly 2.5%. The aspiration is to get to 3.5% by FY29 on their book. So that is, of course, the book ROA. The ROEs are nowhere close to the, or nowhere close to kind of gives you or rather ROEs gives you a much better picture of what profitability does. But of course, on the current book, that's the profitability that Ugro Capital does. Let me talk a little bit about GNPAs, and they've inched upwards. That's been one of the concerns, and that's asset quality. Let's pull up the GNPA ratio. It's inched upwards towards 2.3%. In fact, FY26, we've seen it inch further to 2.6 odd percent. What we've seen, net NPAs, though, they've been fairly controlled. So on that count, we give it to them. The PCR, though, when you're looking at that, it's around 45 odd percent. I'd want to know as to why they maintain their PCR at 45%. Would there be scope to make that better? Is that really the direction in which the management sees asset quality also going forward? Let's look at return ratios now. It's single digit in terms of ROE ratios, and that's one of the reasons why we've not seen much of a move on the stock. The ROE has remained fairly and abysmally low. We want to see that lift in ROA, and at 3.5% ROA, I wonder what happens to ROE. We'll get a perspective of that as well, because we will have to understand what the loan book size is at that point of time and what the equity base will be at that point of time. But they're currently adding around 200 crore to their equity base annually on a capital of around 3,000 crore. So that, of course, needs to improve or go up. Let me talk about shareholding right now. Promoters, which is Sachindra Nath, largely holds around 2%, and there's FI and DI participation. There are some marquee shareholder names out there, and that there is no doubt of within that FII basket. But nonetheless, there is more to be done, and public holds a very large or a significant stake. Around 3/4 of the company is held by the public, and that's how the shareholding pattern currently sits. In fact, the number of shareholders, and you must mark this out, have risen from 12,000 in FY23 to 39,000 now. So you've seen a very sharp increase in retail participation in this company. In terms of analyst recommendations, there are 4 analysts who cover this. All 4 have a buy call, but of course, given that the number of analysts that cover this is so less, we've given on a conservative basis a neutral to this one. 0 holds, 0 sells, but you look at the upside. 105% is the upside that analysts have on this one. In terms of valuations now, it currently sits at around 0.6 times price to book. The historical average has been approximately a 1-time book, so it clearly doesn't trade at a premium, and the last 2-year range is between 0.4 to nearly 2 times book. Again, doesn't trade at a premium versus many of the other NBFCs. I don't want to compare this because the story is evolving and changing, and therefore it's very important to keep that into perspective when you're looking at valuations. Let me go across to Sachindra Nath, who's founder and managing director, joining us this afternoon of Ugro Capital. Mr. Nath, it's always good speaking with you. Let me first start off by trying to understand Q4 FY26 in terms of the numbers. You've done some expense amortization, or rather amortization of expenses has happened this quarter, due to which profitability has been slightly on the lower side, but you're expecting an unwind to happen of that going forward. How should one look at the forward numbers? How should OPEX evolve?
Yeah, so let me, this answer in an absolute term would not make any sense. So as you know that in last February, 7th of February, we announced a strategic realignment. Obviously, I was very patiently listening to you. It looks like always when I hear you, it looks like as in a very high quality analyst, deciphering a company. So thanks for that. But actually, what was this strategic realignment? We have decided that for our cost of borrowing, segments of the market which are below a certain threshold, and especially the DSA-led market, we are not natural owners of that. So obviously, we were trying to do that over a period of last 3 years. And for that, we had to build our small ticket lab business branch infrastructure. We completed that journey. We reached 319 odd branches. And we were confident that now we can scale that up. And that's why we decided to stop all the fresh disbursement starting from 7th of February when we announced that. What it meant that there is a certain amount of exit cost. So we have said that company has rationalized or has taken out 220 crore of total cost. Roughly around 140 or 150 crore of that cost takeout happened from when we acquired Profectus, and balance came from Ugro in itself. This cost consists of the people infrastructure, the credit team infrastructure, branch, all of that. Everything with related to our DSA-led business, we have taken out. So what you're left with only portfolio and collection team, and gradually it will run down. This one-time cost is the cost of, the notice period pay, some of, technology infrastructure we have taken upfront in this quarter, and now they will not come into picture going forward.
Got it. So you've upfronted that, and that amounts to approximately 25 crore, if I understand that right. So what does this do to the immediate ROA impact, say for FY27 on a steady state basis? If I were to just exclude everything else in terms of growth and yield and all of that, just the OPEX, how much should that add to your ROA? Give us a sense.
So Harsh, before I answer that question, I was also listening to your commentary that Ugro share price has never, grown and it trades continuously and shareholders not made money. And I take all of that. But one of the core reason is the shareholding construct in itself. Our focus, so Ugro, and you analyze the shareholder shareholding, but I think so, it was not correct because I think you have to take not from the exchange reported, but what we present. 50% of Ugro is held by marquee institutional investor. So Denmark government owns 15.5, Samina owns 12.5. Then there are two private equity funds which own 9.5. Then Patni family, which has increased their stake when the price went down to around 6.5%. And then there is one more fund. 50% of us is owned by them. Some of them are sit on our board, and balance 50% is largely retail public. What we simply lack is institutional ownership. DI, mutual fund, insurance company, and that's also a function of our market cap. And as you know, the large number of retail investors, sometimes it's difficult for them to take a longer time horizon view, and that's why they are very focused on next quarter result. So company right now is focusing on three things: pivoting its business to a higher yielding portfolio without sacrificing the credit cost, and we have built the infrastructure for that. So our emerging market small ticket LAP would grow by 29 at the cliff of around 25 to 30 odd percent. Our merchant lending would grow same 25, 30 odd percent, and our lower yielding business would run down by 20%. So this would be a portfolio shift happening, and by 29 we would grow total portfolio by a range of 20 odd percent. That's point one. Number two is one of the reasons why our ROEs are low is because we had to raise very significant amount of capital. And that is structural because all of the lower yielding businesses which we have been doing, we were doing that in form of co-lending. In co-lending, when you downsell the loan to a bank or a large NBFC, or predominantly to a bank or a financial institution, you take the NPV value of the spread into your P&L upfront. But that upfronted income or that P&L actually does not count for your capital adequacy net worth, which means that while you have profitability and your net worth have gone up, but in order to maintain regulatory capital, you have to raise more capital. And that is what we are transitioning now. After a transition year of FY27, all of our profitability would add to our capital adequacy net worth and the net worth itself. And that's why we would not need any further capital injection, which means we will not dilute shareholder unless we get to a fair price. That's the point two. Number three, in terms of the transition of ROA, these ROA are a simple function of NIM expansion. We expect that as the portfolio shifts, our in the total blended portfolio yield would go up by 150 to 200 basis point on overall portfolio, and that because OPEX journey is complete would should go to the ROA tree, and that's why we have guided that we should be in the range of 3% of ROA by FY29. But the more important factor is that the future ROAs are adding to your capital adequacy net worth, leading to no dilution. So I hope that you get the picture. In terms of the price, I think so. Look, in terms of the cost of borrowing. See, cost of borrowing, as you rightly said, is a function of rating, but is also of a function of parentage. Most of the large NBFC, when you compare, have a very strong Indian parent, and that leads to a higher rating and lower cost of borrowing. And professionally owned independent institutions like ours are very few, but I think so it would improve. I have also taken a call to increase my ownership. I did whatever as a professional I can do. I did an investment on 30th, and I'll see that as and when opportunity arises, I will do that because market looks involvement, risk participation by the founders more than what it is seen today. But the combination of all of this, I think so, NBFC of our size and scale, we are trading far below what the average mean is, and management is extremely focused to create shareholder value in time to come.
Yeah, I think shareholders will be happy to hear that from you. I'll make that quick change, in fact, Mr. Nath. 64% of the share capital is held by promoters, FIs, various DIIs, and 36% is held by the public. I'll make that change on record. But at the same time, your number of retail investors has gone up substantially between FY23 and FY26. That is the other piece that needs to be acknowledged. And that set or that cohort of your investors have unfortunately not made money. Now, let me take a step back, right? I'm not trying to delve into that part of the conversation. What I want to know is forward-looking. Talk to us about what has led to this strategy pivot. You were lending to a certain cohort of customers. Now you're choosing not to do that business and go ahead and do secured lending and lending through BharatPe and PhonePe. What's leading that strategy?
No, so I think so. It is a continuous self-reflection over last 2.5 years. So it's a math in the lending is fairly simple. Suppose you lend at 15%, you have a credit cost of say on that 15% is say 0.5%, and you have an OPEX of 4%. So you are left with, and you suppose your cost of borrowing is 10.5%, you are left with almost nothing, right? So that is the problem of, lower yielding, maybe better credit quality and high volume business. Now we have presumed that given size of our capital, the institutional ownership, our cost of borrowing would be near to the peer set or in the segment of the market which the big players operate. But what we realized over a period of last 3 or 4 years that the cost of borrowing is a combination of underlying profitability and rating, but also is a function of the parentage. We don't belong to segment of the market which are predominantly driven by cost of borrowing advantage. So at a 10.3% cost of borrowing, we are not rightful player to lend at only 15%. But to make that pivot, so one, you can continue to wait for your cost of borrowing to go down, but which means that you have to continuously raise more capital and dilute shareholder. That's not a right strategy. And second is to build infrastructure which can give you incremental future disbursement and higher yield. What we have been seeing that the small ticket LAP lending for MSME have held, credit costs. It has done fairly well. It required a massive physical infrastructure. And in last 2 years, we have built from almost 75 locations to straight 318 locations. And when that journey got completed, when we acquired a fintech called MyShub Life and we got embedded into, all 3 large payment platforms, Paytm including, we realized that this is the time now we can stop all lower yielding business and transition to only higher yielding business. So it is continuously happening.
Point taken. Mr. Nath, I have exactly 3 minutes and I have plenty of questions. So I'm going to try and make this quicker. Give me a sense, therefore, your loan book will largely remain at 15,000 crore, say in FY29 as well, because you'll replace all your old borrowing mix with the tilt in the portfolio that you're trying to create?
No, I think so. The guidance is that the FY27 would be flattish, and then it would start growing. And the math is 25% growth rate for EM LAP, 25% growth rate for merchant lending, and 20% rundown of the non-focus portfolio.
So where does that leave your portfolio, sir, in FY29? Give us a sense. Your total book.
And on a CAGR basis, I think so we should be roughly around 20% up in next 10 quarters.
Got it. Okay. So 20% higher. You'll be in around the 18 to 19,000 crore number in terms of AUM. Understood. And this very, very high yielding book, it's also an unseasoned book, right? To a certain extent. Give us a sense of what the risk is on the new book that you're trying to build out.
No, it's not unseasoned. We have been in this business for 5 years. We have built a cohort of 1,000 crore of portfolio, tried and tested it. There are multiple players. We decided not to go in higher yielding segments. So there are players who do it at 25% lower ticket size. We operate in 7.5 lakh to 50 lakh rupees of band, self-occupied residential property or commercial property, for a customer which has, visible cash flow and a small MSME customer. And I will just quickly add on the provision coverage ratio. One of the reasons our provision coverage ratio is 47% because our 70% of our portfolio is secure. Actually, 89% of our portfolio is a secured portfolio. 70% by collateral, business loan is by CG to MSME, which means that loss given default is much lower. So that's why we don't have to provide for that.
Understood. Yes, so that makes sense. So that was one part of my question, and thank you for answering that. Give me a sense, therefore, how should the ROA function? I know that you've given us a perspective very briefly with regard to the ROA tree, but if yields were to go up so sharply on a predominant part of your book, and my understanding is, and the kind of understanding you've given us in your slide deck as well, is that around 30 to 40% of your book will be the traditional, or rather 15% of your book will be the traditional business which you used to do, and 85% of your book will now be the new business which you're pivoting towards, or the business that you have which currently constitutes around 30% of your business, which means sharply higher yields for you. Why wouldn't ROA go up significantly?
It's a transition. It's over a period of time, right? So this, the total portfolio yield would go up only by, 150 basis point, and that would get translated. So, it's not building loan book is not a quarter's journey. It's a, so if you look at this way, today of our 318 location, around 100 location, which are at the average productivity of 80 lakh rupees per month disbursement, which is our targeted disbursement rate. But a very large cohort of younger branches are half of that. So over a period of next 2 years or so, when all of them would go there, then only you'll get this level of AUM disbursement yield uptake. And that's why we are looking at the range of what we are saying. Predominantly, most of the lendings, on a secured basis, would be in the range of 3.5% of ROA. Those you see which are at a higher ROA have a less leverage, because once the leverage would come in, ROEs would go up and ROEs would come down. Our ROEs would also go up with more leverage. We are, not fully levered, and over a period of time, a little bit of more leverage with a combination of co-lending will improve the ROEs.
Understood. You're going to do higher risk lending. That is for sure, Mr. Nath. What does it do to your credit cost? Give us a sense of how much you're penciling in terms of an increase in credit cost. What would your normalized credit cost be? And how does that impact your ROA? Also, embedded finance. It's something that every lender wants to try to do, right? And at 26% yield, I'm trying to understand whether competition will allow you to hold on to that kind of yield.
Yeah. So first on the secured lending side, I think so there is a difference between what would go up little bit is the GNPA, because it's the profile of the customer. The customer will continue to miss. So I think so we have operated always in a sub 2.5% of GNPA range. That would gradually inch up over a period of time because this is the nature of the customer. But the credit cost, which has always remained in the range of around 2%, we don't think so that would go up because we are consciously only doing secured lending, which means GNPA to flow back by taking the asset under possession and selling it and recovering money is very high. So guidance is GNP would go up, but that should not alarm, that should not worry, because that would not flow into the P&L through credit cost. We will be able to recover. On the merchant lending side, I think so the yield is largely controlled by the originating partners because they take a large share of that margin, whether it is Paytm, PhonePe or BharatPe. The moat there is a deep capability of data analytics and technology integration. So in the universe of NBFC lenders, while everyone would like to do this, but to level of integration, technology, deep data science, being able to get these loans repaid on a daily basis and all of that is a time-taking journey. And market is very, very deep and wide. So out of the total in the merchant base, which are on QR code, we are only a fraction of that. So let other people also come. But I don't think so that for our share, it would impact us much.
Okay. Mr. Nath, I can go on, but unfortunately, completely out of time. Thank you so much for coming in and speaking with us and being very candid while at it. So thank you for that. And viewers, that's all the time we have. Thank you so much for tuning in.